We think there's a huge opportunity to disrupt the credit card industry in the US.
This Cyber Monday, consumers are trading in their shopping bags for virtual cards.
As the scope of buy now, pay later expanded, the industry's growth has exploded in the US.
The lion's share of our income, 90+% of our income, is made from the merchant, not the consumer.
What if one of the fastest growing financial products in America isn't helping people avoid debt, but helping them hide it? This is Fiscal Forge. A decade ago, most people had never heard of buy now, pay later. Today, it's everywhere. Online stores, retail chains, airline tickets, electronics, furniture, even groceries. At checkout, consumers are presented with a simple choice: pay today, or split the payment into smaller installments. No complicated application. No long approval process. No visible credit card balance. Just a few clicks, and the purchase is yours. It sounds almost too good to be true, and that's exactly why millions of people embraced it. But beneath the convenience lies a fascinating story. A story about psychology, consumer behavior, financial innovation, and a rapidly growing industry that has quietly changed how people spend money. The question is not whether buy now, pay later works. The question is whether consumers fully understand what they're signing up for.
The U.S. is a credit card market that is pretty rich with rewards for folks that have good credit scores and incomes and large credit limits. And that's not really what buy now, pay later is designed for. It's designed for people who are not quite in that level, might be kind of a mid-prime credit score, not as much open to buy on their credit cards.
The size of the consumer credit industry writ large is enormous. There's over $1.2 trillion of revolving credit balances in the U.S. and over $5 trillion in consumer credit transactions in the United States. Those numbers are just so enormous. So here at Affirm, we're focused on chipping away at as much of that as we can, with a pretty clear understanding that it's not going to change overnight.
The success of BNPL didn't happen by accident. It emerged at the perfect moment. Online shopping was growing rapidly. Smartphones made purchases frictionless. Consumers increasingly preferred digital payments, and younger generations were becoming skeptical of traditional credit cards. BNPL companies saw an opportunity. Instead of offering revolving debt like credit cards, they offered installment payments. Simple, clean, easy to understand. A purchase could be divided into 4 smaller payments. And because the payments felt manageable, adoption surged. Many consumers viewed BNPL as a smarter alternative to credit cards. Less intimidating, less complex, more transparent. The result was explosive growth. Within just a few years, BNPL transformed from a niche payment option into a global financial phenomenon.
We think there's a huge opportunity to disrupt the credit card industry in the US.
One of the largest buy now, pay later players, Klarna, saw its stock pop 15% during its public trading debut. Beyond the direct challenge that buy now, pay later loans pose to credit cards, big banks and financial institutions have other reasons to be cautious of consumers who use these plans, especially as the number of users continue to grow. In 2024, an estimated 86.5 million Americans used buy now, pay later loans, and the number could rise to 91.5 million in 2025.
Buy now, pay later to date represents a giant black hole in the credit profile and their understanding of consumer credit quality.
When any new product gets introduced into the marketplace, there's skepticism, there's uncertainty. Credit cards and banks and others want to protect their own products as well. And so we're in that transition time.
So what's behind the rise of buy now, pay later loans? And why are traditional lenders like banks and credit card companies wary of them?
The real innovation behind BNPL isn't technology, it's psychology. Human beings naturally focus on immediate affordability. A $400 purchase feels expensive. 4 payments of $100 feel manageable, even though the total cost remains exactly the same. Behavioral economists call this payment framing. The way a price is presented changes how consumers perceive it. BNPL takes advantage of this principle remarkably well. Instead of focusing on total cost, consumers focus on installment size. And smaller numbers feel safer, more comfortable, more affordable. As a result, people often spend more than they otherwise would. Not because they're irresponsible, But because the purchase feels easier to justify, this psychological effect is one of the primary reasons BNPL has become so effective. It doesn't change the price. It changes the perception of the price. Many consumers assume BNPL companies primarily make money from late fees. The reality is more interesting. A significant portion of revenue comes from merchants. Retailers pay BNPL providers because BNPL often increases sales. When installment payments are available, consumers are more likely to complete purchases, spend more, and abandon fewer shopping carts. For retailers, that's valuable. For BNPL companies, that's profitable. Some providers also earn revenue through late fees, partnerships, interest-bearing financing plans, and other financial services. In other words, the customer isn't always the primary source of revenue. Sometimes the retailer is. And that's an important distinction, because it explains why BNPL options appear almost everywhere. Retailers want them there.
This Cyber Monday, consumers are trading in their shopping bags for virtual carts.
Less people to deal with, and I feel like they have better deals online.
Whether it's store credit cards or dipping into savings, more Americans are finding ways to check off their holiday shopping lists, even if it means going into debt.
And that's the last thing anybody needs right now.
With rising inflation, LendingTree's Matthew Schultz says shoppers are turning to buy now, pay later loans, or BNPLs. It's a relatively new service that 4 out of 10 Americans rely on. Similar to layaway, it allows people to pay for items over time.
It's actually been great. I've used it before, like bigger ticket items or something like that if I want to space out the payment.
The truth is that buy now, pay later, if you use it wisely, can be a really good way to get more for your holiday spending buck.
The biggest risk isn't a single BNPL purchase. It's multiple purchases. 1 installment plan feels manageable. 2 feels manageable. 3 feels manageable. Then something interesting happens. Consumers begin losing track. Several purchases become dozens of payments. Across multiple apps, across multiple retailers, across multiple due dates, the debt remains fragmented, which means it often feels smaller than it actually is. This phenomenon has become increasingly common. Consumers don't necessarily realize how many future obligations they've accumulated until those obligations begin arriving simultaneously. And that's when convenience can quickly become financial pressure. As BNPL expanded, regulators began paying closer attention. The concern wasn't simply about borrowing. It was about transparency. Traditional credit products are heavily regulated. Consumers generally understand they're taking on debt. BNPL often feels different. Many users view it as a payment method rather than a borrowing product. Yet financially, future obligations still exist. That's why regulators in several countries have increased scrutiny. They're asking important questions. Are consumers receiving adequate disclosures? Do borrowers understand the risks? And how should BNPL fit into the broader consumer finance system? These debates are likely to continue for years because BNPL sits at the intersection of technology, retail, and lending.
As the scope of buy now, pay later expanded, the industry's growth has exploded in the US. Buy now, pay later transaction volume has multiplied 20 times since 2019.
You have the clear macro trend around consumers choosing alternative ways to pay.
And that's led to growing competition for both customers and merchants. In March, Klarna announced an exclusive deal with Walmart to provide loans to customers through the retailer's fintech arm, OnePay.
It's extremely important for the BNPL providers, particularly the specialist BNPL providers, to have those direct relationships with the merchants.
There's a lot of ground out there and a lot of transactions that there's currently nobody being offered. And so I think there's a lot more white space than there is fighting over existing merchants.
The types of merchants that have adopted BNPL have expanded, and that's changed what people buy with their loans.
Despite the concerns, BNPL itself isn't inherently bad. Like any financial tool, its impact depends on how it's used. For disciplined consumers, installment payments can provide flexibility, cash flow management, and short-term convenience. The problem begins when convenience replaces planning, when purchases are made because payments seem small, when multiple obligations accumulate unnoticed, or when future income becomes committed too aggressively. The most financially successful consumers approach BNPL differently. They ask one simple question: would I still buy this if financing didn't exist? That question alone can prevent many costly mistakes. At first glance, buy now, pay later appears revolutionary. And in some ways, it is. It made financing simpler, faster, and more accessible than ever before. But beneath the innovation lies a familiar concept: debt. Packaged differently, marketed differently, presented differently, yet still dependent on future income. The true story of BNPL isn't about technology, it's about behavior. Because the greatest financial risks rarely come from products themselves. They come from how those products change human decision-making. And that's the lesson many consumers are only beginning to understand.
And a regulatory framework that respects those components of the product and builds the framework around something that is very different to traditional forms of credit is one that we've been really hard at work on from the day we started the business.
I don't think that BNPL will replace credit cards. I think it's going to replace credit cards for certain people and may replace credit cards for many people for certain types of transactions.
Even if BNPL providers would prefer credit cards disappeared.
Nothing would make our team happier than if we could see the death of revolving credit in the United States.
Buy now, pay later isn't going away. If anything, it's becoming more common. The industry continues expanding into new products, new retailers, and new categories of spending. The real challenge isn't stopping BNPL, it's understanding it. Because financial products are most powerful when consumers fully understand their incentives. Who profits? Who benefits? And who carries the risk? The more consumers understand those relationships, the better financial decisions they can make. And in a world increasingly built around instant gratification, that understanding may become more valuable than ever. If you enjoyed this breakdown, subscribe to Finance Decoded. Every week, we uncover the hidden stories behind banking, debt, credit cards, investing, and the financial systems shaping everyday life. Because the biggest financial lessons aren't always found in textbooks. Sometimes they're hidden behind the checkout button, and understanding those lessons today could save you thousands of dollars tomorrow.